So this is chapter 1, part 3 of our lecture video, whiteboard video, and we were just discussing some of the basics of the accounting process. We're going to now get into the nuts and bolts of the accounting and how to record transactions. But before we do that, we want to talk about the framework that we're going to use for accounting. And by the way, we're going to use this framework forever, for the rest of the course, for all of accounting. It's always going to follow this same framework. So as we're working through this course, it's extremely important at this point to be comfortable with the concept here and to always fall back to this concept, this framework, whenever we're recording transactions, whenever we're thinking about the mechanics of accounting at least. That it be consistent with this concept, because it's never going to change. So first of all, let's just take a hypothetical example. Let's say that we were going to go into the rental property business and we were to purchase a rental property. So let's say we were to purchase a house, and let's say we purchased it for $400,000, and I'm going to leave the thousands off. And let's say we took out a mortgage for $300,000. That would leave a down payment of $100,000. So that would be a typical way that you would purchase a rental property. You would, of course, borrow the money. Chances are you don't have $400,000 laying around. You would have to come up with the down payment, though. In this case, we're coming up with 25% of the amount, and then, of course, we're going to borrow the balance. We're going to go to a bank or a mortgage lender of some type, and we're going to get a mortgage for $300,000. So I think that's probably a fairly common sort of a transaction that people would understand. Now, we're just going to put that in accounting terms. In accounting terms, the house would represent an asset or a resource. And we'll talk about these later in terms of defining these more specifically. The mortgage would represent a debt, or in this case, in accounting terminology, a liability. And the down payment, or the residual amount that's left over, would be what's called our equity. And you hear people refer to the equity in their house as the amount of money that they have, the value of their house after they pay off the debt that's owed. That would represent the equity. So obviously in this case, if we were to pay off the entire mortgage of $300,000, our equity would go up to $400,000, equal to the amount of the asset. So the framework that we're going to use from now on in accounting, and I'm just going to switch pens real quick. So the framework we're going to use from now on in accounting is going to look like this. We're going to have, basically we're going to have assets equals liabilities, I'm just going to abbreviate, plus equity. In this case, we're going to have the house, which is $400,000, and that's equal to the mortgage, which is a liability of $300,000, plus, in this case, the down payment, which is the equity of $100,000. Every time, so basically if we were to record that transaction, we've recorded an asset of $400,000, a liability of $300,000, an equity of $100,000, and as you notice, we're in balance. That equation is in balance. We're always going to want that equation to be in balance. So this equation must always be in balance, okay? We're always going to make sure that we're in balance. So every time we have a transaction that we're going to record a business transaction, we are going to want that to stay in balance. Okay, so that's basically the framework that we're going to use. Now let's just define some of these terms, okay, and then we'll go through an example of what's happening. All right, so assets, so let's talk about assets. Assets are going to be, assets are what are basically, we can talk about those in terms of resources. The resources of the company, they have a life of greater than 1 month. So for instance, paying the electricity bill would be a resource because we're going to be able to operate our business for in the future by virtue of paying the electric bill. But we pay the electric bill each month, and therefore it's not considered an asset. It's going to be considered an expense. Something like a building is going to have a useful life to our business of more than a month. In fact, it could be many years. That's going to be an asset. So that's the distinction we're going to make. If it's greater than 1 month, it's going to be an asset. If it's less than 1 month, it's going to be an expense. So examples of expense would be employee payroll. Employees are not assets. We don't own them, and we're only paying for them at most a month at a time. The electric utility bills, things like that, those are usually expenses. If we had to put gas in our car, that would be an expense. That would not be an asset. That's going to be used up in probably less than a month. So assets are going to be things, generally speaking, they're also owned. So we don't own the electricity, but and there's some examples where we don't necessarily own the asset, but for this purpose, I think we can assume that assets are owned. For instance, in the building, equipment, cars, the cash in our bank account is an asset. Any supplies that we purchase, things like that, those would be assets. We own those. And most importantly, they generate revenue, directly or indirectly. That is the most important, because first of all, if they don't generate revenue, then why do we own them? Okay, they should in some way generate revenue for our business. And we'll talk about what revenue is in a moment. If they don't generate revenue, the question is, why do we even have them? Okay, so liabilities, again, I'm just abbreviating. Liabilities are amounts that are owed to others. So amounts owed to others. And by others, I mean amounts owed to people other than the owner. So amounts owed to others, they could be debts, and they could be amounts that we owe. Let's say we purchase something on credit, so we owe that to what's called a creditor. Okay, so amounts owed to creditors. Equity. Is the excess of assets over liabilities. So it's kind of the residual value. And equity has 4 components to it. The first component is any investment by the owner of the business or owners of the business. Okay, so in this case, just like up above, we invested, we made a down payment of $100. That was the equity. So if the owner invested any money into the company, that would be part of the equity. Now, in this book, we're assuming that we are a corporation. So if it's a corporation, then this would be any investment in what's called common stock. So what happens is the owner will invest money into the company and in exchange receive stock. And the stock is basically just little printed up certificates that indicate that he is or she is the owner of that company. They have a specific ownership of that company. So for instance, if I invested $100 for 50% of the company and someone else invested $100 for 50% of the company, I might get 2 shares of stock and the other person might get 2 shares of stock. That would represent our ownership in the company. Each share would be worth $50. It'd be worth the $100 we put in. And it would also indicate that we both had the same number of shares. It would also indicate we both own the same amount of the company. We both own half of the company. So the common stock is merely an indication of our ownership interest in the company. So investment by the owner is part of equity. On the other hand, the opposite, and so that would increase the equity of the company, any investment by the owner. On the other hand, any withdrawal of any cash by the owner or owners would be a reduction of equity. In this case, dividends. Dividends are what are called what are withdrawals. So if I receive a dividend, if I own a share of stock, let's say, and I receive a dividend, that's actually money that is being withdrawn out of the company that is being paid to me because I'm an owner of that company. If I'm a stockholder, I'm an owner, and I'm getting repaid some of the earnings of that company in the form of a dividend. So that's a minus. That reduces the equity of the company. The third element of equity is what's called revenue. Revenue is the sale of goods or services. Remember, that's why we're in business. We're in business to generate revenue. We're in business to sell goods or services. That's going to be an increase in equity of the company. And the final thing is expenses. Expenses are costs necessary to generate revenue. And remember, they're less than 1 month. They have less than 1 month life to them. So whatever it is, it's not going to be around for more than a month. And that is going to reduce equity. So those are the 4 components of equity. Owner's investments, owner's withdrawals, it's going to be increased by any revenues and decreased by any expenses. So we're going to come back and go through an example